our liquid net worth went from, 6 figures to 8 figures in a single day.
What are some things that you've seen that people can do to keep their kids grounded and not becoming spoiled brats? And
not everyone will agree with me on this, but my personal opinion is to not hide the situation from them. Eventually they will find out. And if you haven't been role modeling honesty, I don't think that's a good legacy to leave. I'd say the only real, serious mistake I've seen people make that is hard to come back from is too quickly over-optimizing for some sort of tax structure. And then all of a sudden they realize, well, I actually don't have access to my money anymore. If you did something that violated tax law, you're probably not going to go to jail if you listen to somebody over it, but you're going to.
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Tad, you've interviewed hundreds of people with $5 million to $30 million in investable assets. Why do so many founders feel more anxious after the exit and not less?
I would say that they feel differently anxious. Before the exit, you have, I think it was Charlie Munger who said, you don't need to put your eggs in a lot of baskets. You can put all your eggs in one basket and then watch that basket very carefully. And so that's what you are as a founder. I myself started a SaaS company. I bootstrapped that to about 75 employees before selling it to a strategic acquirer. So up to the day before I sold, I had 95% of my net worth tied up in this one illiquid microcap asset. But I knew that in and out, right? I knew what the daily cash flow was on that. I knew every customer we were at risk of losing, what the sales pipeline looked like and what customers we might win. I knew every HR dynamic that was going on. I knew if we might get sued, et cetera. So I had perfect information and could spend 12 hours a day just thinking about this one company. I think when you then have had your exit, in some ways your risk goes way down because you go from having all of your money in one company to either, okay, it's now all in Google stock and somebody else is worrying about it, or you have it in cash and it's diversified, et cetera. But you're out of your comfort zone. You've probably spent, in my case, I spent 10 years. That's probably, relatively typical building the company. And so, that in and out, all the dynamics, the market cycles, et cetera. Now you're in a position where you are acting more like a family office or a CIO, where you're trying to think about, okay, what's the efficient frontier? How do I think about balancing, not just stocks and bonds, but is there a role for private market assets? And, should I even think about energy? Should I think about litigation finance? Should I think about tax impact, et cetera? And so even though you're more diversified, it's just a whole bunch of stuff that you have never thought about before. And then I'd say the one other thing is that for a lot of founders in particular, they see this as likely a one-shot deal. And so you say, okay, I don't know, if you're somebody who's working at Google and getting a big bonus every year, you might screw up your $100,000 or $300,000 bonus, but you're probably going to get another one next year. You're probably getting a big paycheck. Whereas if you're somebody who's put all your eggs in that one basket of building this company, you get one shot to get this right. And so if you screw up and lose, you're getting $20 million, but then you lose that $20 million, there's no mulligan on that. There's no bonus next year.
Yeah, no, lots to unpack there. You mentioned your own exit, but I just want to back up a little bit. The term bootstrapping, I have a varied audience here on the Investing to Win podcast, but let's just talk about what bootstrapping really is as founders, as entrepreneurs.
Yeah. So, what it means technically is that you don't take outside capital. You say, we are going to build this business based on the organic cash flow generation. Typically, that's augmented by the founders not paying themselves for some period of time. I think for our first equity. 5 years, we probably paid ourselves $30,000 a year on average, which was not easy on the marriage. But you're basically, as you said, sweat equity. You're trading the fact that you have a lot less cash to deal with. The benefit is that you own all of the equity, or maybe you give some to employees, but you're not giving it to outside investors. So that's the technical definition. I think some of the qualitative things that come along with it. On the positive side, one is, again, if you are fortunate to be successful, you get a bigger share of that exit. Second is you maintain control, where if you say, hey, maybe I'm somebody, I don't want to grow this thing to be $1 billion business. I'm very happy to grow it to be $100 million business. A venture capital investor, the nature, and sometimes people look at this as a pejorative thing. I'm not making this a value judgment, just the way their model works. They are not interested in doubling their money in your company. They would much rather say, hey, I want you to swing for the fences and have a 10% chance of getting 100x return. Because if I put that into 10 companies, one of them is going to do 100x, my fund will do 10x overall. I'm great. And I don't really care about that the other 9 failed. Whereas if you're a founder, you say, well, I would much rather have a 100% chance of doing a 5x return. Probability weighted, it's less money, but I want to be sure I'm going to 5x my money and not, buy a lotto ticket. So I think there's that level of control. And that can also be how you run the business. You can say, hey, the right thing for my employees, the right thing for my customers is to grow in a little bit more measured pace to make this more long-term sustainable. And you just keep that control there. I think there are also, in our case, the reason we bootstrapped it was largely the market we were going after was not one that lent itself to a multi-billion-dollar outcome. So we were selling to universities and hospitals. There were probably 1,000 potential customers worldwide. It was only the biggest ones, your Harvard, Stanford, Oxford, University of Singapore, places like that. And so that was a very good market for one company that didn't need to become $1 billion company and say, okay, there's a few $100 million of revenue here. It's big enough to support one company. But again, a venture capital firm, it's not going to be the next Anthropic or Google, so it's never really going to be interesting to them. So that's really what bootstrapping means.
Yeah, no. So tell me a little bit about, let's even go back. I know that was you and a friend or a buddy, how 10 years. I mean, that's a long time.
Long time.
What SaaS company, obviously, I'm also in the SaaS space. What type of things were you selling?
So as I said, we were selling to universities and hospitals, and we focused on their basic research side. So the ones that are supported by NIH grants, the basic research on, cancer centers were our biggest one. And so that was not clinical trials for patients. It was really much more our customers were trying to figure out, what does this gene do? How does it express itself? So they were doing lots of experiments with, fruit flies and zebrafish and mice and things like that. So specifically what our software focused on, it was helping to manage their very expensive research equipment, where if you're a big hospital, let's say you're Sloan Kettering Cancer Center, you might have 1,000 different professors who are all getting this grant support, and each of them needs access to $10 million worth of equipment. Well, you're not going to buy 10 billion of equipment, each of those guys getting their own 1000x microscope and getting their own mouse colony and their own, super magnets. You're going to buy those as Sloan Kettering, and then you're basically going to rent them back by the hour to these different professors. And so we handled that business process of tracking what exists. People could sign up to use the equipment. And there was a lot of NIH mandated reporting around, tracking the budgets of what was paid for this, creating reports, what kind of discoveries were made out of the usage of this equipment. So that's really what our software focused on. And it was in some ways it was an incredible end market, because you could feel a real passion. If you're selling, I don't know, certain kinds of, if you're selling software to an end market, you don't care that much about, okay, I'm selling the lawn care end market. Sure, I want my customers to be successful, but does it really matter that much if lawn care companies are more profitable? I would argue it's not that important. But, it's very easy to rally around this idea of, okay,
sure, of course,
we want to help advance the pace of scientific discovery. Our customers are literally out there trying to cure cancer. And if we can make them 10% more efficient, then we have made the world a better place. Our employees really believe that narrative. So we were, say, fanatical about customer support. And it was just easy to say, hey, it's the right thing for the business, but even more importantly, being fanatical for the customer is the right thing to do, period. And so really rally around that. Now, there's some ways in which it's a terrible end market where they don't have much money. They have extremely slow budget cycles. If you look at things like the, latest changes in the administration about how they're supporting research funding, it can upend everything. And I'd say generally our customers, they felt underpaid and underappreciated. So they didn't really like this idea of, okay, a vendor's out there making money and building a company. So, everything has its pros and cons, but that was the pros and cons of our particular end market.
Yeah, it's interesting. My former life, I was in medical research. I worked at the virology lab. So that would be very similar to NIH or the CDC, but up here in Canada. Yeah. And I remember at budget time, we got to spend $1 million. We have to do this. We have to do that. And just boxes and boxes of a brand new electron microscope and software that's already outdated 2 years later because people just didn't want to lose their budget from the next year. Yep. So I like what that model that you're describing, because you see a lot of downtime with a lot of this equipment. I think a lot of founders don't think of exits, right? They think, oh, I have a good idea. They're really optimistic. They work their butts off. Have you seen that in your travels, so to speak? A lot of people don't think about the exit until it's staring them right in the face.
I think that's right. And I think that's probably the right thing to do. If you start a company in order to sell a company, you're probably not going to have the passion to stick with it through those 10 years, because at the end, you can look back in retrospect and say, well, this was a great journey. Like in our case, I could say, hey, we grew 50% a year every single year. But in practice, that meant year one, we had 20,000 of revenue. Year two, we had 30,000 of revenue, then 45,000. So by the end, we got to, okay, we're growing from 5 million to 7.5 million of revenue is, these big numbers. But I don't think, I think you have to do it for the passion, because, you really want to work for yourself, or you really believe in this end market, or you really believe in this technology. And then that exit is almost the cherry on top. But if you're planning, and also, most companies don't make it to a 8 or 9 figure exit to a big, public company or private equity firms. Most of them are maybe going to kick around for a while, maybe throw off a little bit of profit, maybe just go out of business. So you also don't want to set yourself up where the 10% outcome is the only one you're happy with. And, the other thing I would say is, if you build a company that you are happy owning yourself, and this is one of the things I liked about bootstrapping, is we never had a burn rate. We always said every year our constraint is we can only spend as much money as we bring in, because there is no separate pot of money out there. But what that meant is we never had to sell the company. So if you end up in some COVID or some .com bust, or, as of the recording time right now, the SaaS market is getting slaughtered, Salesforce is down a quarter in the last month, then you might be in a position where the VC turns off the taps. And if you run out of money, you have to sell out, into a fire sale. And so building a company you're happy to own is, you have the luxury of timing your exit. And also, that's the kind of company that somebody wants to buy. Where I've spoken with a number of entrepreneurs in our community. Many of them were actually, more than you would think, were in our bootstrapped circumstance. And they have found the post-exit transition to be much easier, because if you go in, the company that bought you, whether it's private equity or whether it's a public company, they all have this mandate of, you have to make profit. You have to make distributable cash flow. And yes, we want to grow, but it has to be profitable growth. And it can be very jarring for a company whose model was based on, lighting money and fire, to all of a sudden have to pivot to profitability. Whereas if that was always the case there, then it's a much easier transition to make.
Yeah, I know that private equity and roll-ups and things like that. Do you have any, looking back, of course, we talked about the Super Bowl last night. It's easy to be an armchair quarterback, but looking back, do you think there was a point in that 10 years that you could have accelerated the growth, knowing what you know now, for a bigger exit or a quicker exit?
Yeah. Yes. I think, if I were starting that company again, we probably would have had a better outcome. I think the first couple of years we spent some time pivoting, where fortunately we figured this out quickly enough that we were able to get on the right path. But we probably spent 2 to 3 years going after a sales level of selling to the individual lab where your average ticket size was $5,000. We finally realized, we have to sell to the university level. So up in Canada, we had customers like, Hospital for Sick Children, or, University of Toronto, where they were selling for 50 or 100,000 a year, or maybe 200,000 a year. And so one was, figuring out that your sales cost, your customer acquisition cost, sales cost really has to align with your basket size. So I think that was something. I think if I were doing it again, and probably with, in a situation now of having one exit, building that again, I would probably be targeting a bigger exit. So we could have diversified in some adjacent spaces and say, okay, let's try and become not just the category leader in the shared equipment, but really have comprehensive animal facility management or comprehensive storeroom management, or things where, or, really try and break into the private sector pharmaceutical side, not just the basic research side. So there's things you could have done to say, okay, rather than targeting a market of, 100 or 200 million, we're now targeting $1 billion market. But, that said, I think very happy with what we got out of it, both financially and learning wise. The only way you get that experience to do it better next time is by doing it the first time. So I think it's also easy to be hard on yourself and say, well, what more could I have done? And I think also, honestly, if we hadn't sold and just held on to it, we would have made more money. But I don't regret that. It got to a certain point, as I said, where more than 90% of my net worth was in this single company, with just all the esoteric risk that's involved in owning a very small company. And so saying, hey, I'm going to ring the register here. I'm not going to ride this for another double. I'm just going to put my money in stocks, and I'm still young enough. I can do other things. And, I don't have to go golfing just because I've sold this one company.
Yeah, no, I know there's some kind of formula out there that one of my mentors said, and I don't want to butcher it, so I'm not going to say it on air here, but it's like taking your age plus the equity that you have in the company And if it's above a certain line there, then you're at risk of losing the majority of your wealth
Yeah.
because you've got everything, all your eggs in one basket. Um, I wanted to kind of pivot a little bit because you started this group that we'll talk about in a second, mainly because of your own sort of harsh reality after you had this exit. Do you want to talk about what was facing you? Because you guys were 10 years just grinding, 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 and then you
Yeah.
have this exit, and then all of a sudden it's like, I didn't prepare for this. Tell me about that.
Yeah. So in some ways, technically, our net worth didn't change after the exit because the company was worth that before we sold it, but our liquid net worth went from 6 figures to 8 figures in a single day, and so you all of a sudden have all these new questions of estate taxes, umbrella insurance, how to talk with your kids about wealth, how to make sure that wealth is an asset to your kids and not a liability to them, travel, whatever it is, and
Sure.
you have not some people who, let's say you're a partner at a white shoe law firm, you're going to end up with all those same questions, but you're going to baby step into it, right? As you get promoted and each year you sock away money and you grow your net worth by 10%, as opposed to just, you're getting 100x change on a single day. And so all these new questions, and I would say when you get into what banks would call a very high net worth or ultra high net worth, so maybe, north of 5 million US, there start to be a set of questions that are not as well covered by mass market advice. So if you're trying to say, hey, in America, I'm sure the terms in Canada are different, but like a 529 plan or 401k plan, sort of basic, targeted at a majority of the population, kind of investment strategies and vehicles. You could ask the dad next to you at the soccer game, like, hey, have you set up a 529 for your kids? And that's a normal question. But then if you're asking them this question of, hey, I'm thinking about creating this irrevocable trust structure here in order to maximize my estate tax exemption, you're both going to lose a friend and you're probably not going to get useful advice. But you do have these questions. And so the challenge that, my partners and I faced was, all right, we have these questions, but the only seems like good source of information here, it's like Goldman Sachs or Credit Suisse. But then you have this misaligned incentives question where you don't want to ask the barber if you need a haircut. You don't want to ask the life insurance salesman if you need life insurance. You don't want to ask Goldman Sachs, how you should be investing your money. So we said, okay, we want to set up a group of people who are in the same situation, who are not trying to sell each other anything, but are just first person actually trying to work through these questions together. And so that's we set up this group called Long Angle, which initially was basically just like a glorified Slack channel. As it's turned out with a dozen of our friends, it's turned out that need was much more broadly felt. So over the last 5 years, we've grown to a little over 7,000 members of that, almost all just through word of mouth of people saying, hey, most people have a network of 2 or 3 people in a similar situation. Maybe it's their brother, maybe it's their co-founder, maybe it's this person who is a very helpful board member. And so kind of referring those people, and really with that same mission being non-solicitation, just kind of peer-to-peer advice on, hey, how do you personally think about, whether it's a personal question like, all right, maybe I want to start flying business class now, but I don't want my kids to get used to flying business class. How do you navigate that dynamic, to, again, these things around, things like estate taxes or things like investing. Hey, I mentioned at the beginning, is there any place for private equity in my portfolio? How do you think about that? Should I bother with it, et cetera?
Yeah, I can't even imagine being yanked from the day to day and all of a sudden facing, I'm sure there's a lot of people, friends, family who are like, okay, those are like nice problems to have, Tad. But in reality, it's like, it's a big deal and it causes stress. And that's really why I wanted to have you on the show, because and you said it yourself, an exit seems to cause more stress when you think, oh, wow, I'm free. Right. And that's what we kind of said at the beginning. What are some things, I think you've referred to it as a exit trap, but what are some of the signs that you might think that a founder heading for an exit might be experiencing to know that they're sliding into this trap of not knowing?
I guess I would say one thing is there's not pressure to do something on day one. So let's say somebody, I think the right thing actually is just to focus on your business and not spend too much time counting your, winnings before you have them and planning out, okay, what's my optimal portfolio allocation when you don't actually have the 10 million today. So I'd say by far the best thing you can do is to make sure that exit actually closes, make sure the money's actually in your bank account, make sure you negotiate that contract with tight legal protections, et cetera. Because if you end up missing, just having the money sitting in zero interest checking for 6 months, okay, you've lost out a few percent interest. Like, you can overcome that. You can't overcome the deal blowing up and now your company's out of money and things like that. So
Right.
I actually think there is nothing irresponsible about just keeping your eye on the ball, getting the exit done. And then once the money's in your bank account, now take a breather and think about how to spend it. I do think there's in my mind, somewhat misplaced fear of, if you hear about the lottery ticket winner, that something like 2/3 of them are bankrupt within 5 years. I don't know if that stat is true about lottery ticket winners or maybe, NFL draft picks, something like that. I don't think that is particularly true of entrepreneurs, because even though it's a one-time event and new things for you, first, they are very clear about the amount of effort that went into it. A lottery ticket winner may feel like, oh, I just put $5 down and now I have, $5 million, and that just sort of happened. If you built this business through blood, sweat, and tears over 5 or 10 years, you're going to take the responsibility seriously. And also, there's a lot of transferability in the skills you've built up. You can't build a business without understanding how to read a cash flow statement, without understanding, the basics of legal and HR and finance and that sort of thing. So even though there's a lot of new content to learn, I think people have a solid baseline. So I wouldn't be too worried about people making catastrophic mistakes on day one. Most people have some sort of toy they buy, like, okay, maybe this is not me. I'm not a car guy at all. But if you're a passionate car guy and you spend $250,000 on your Ferrari, that's 1% of your net worth. Like, that's fine. You can buy the Ferrari. It's a dumb decision, but it's not really going to hurt you any to make that dumb decision. Or, maybe you pay off your mortgage. Again, that's not an optimal decision long term. If you've got a 2% mortgage, you ought to hold on to it. But if you're more comfortable just paying it off, again, that's not a big mistake in the scheme of things if it makes you happier. I'd say the only real, serious mistake I've seen people make that is hard to come back from is too quickly over optimizing for some sort of tax structure. And one would be, oh, I have this really, I heard Bill Gates does this complicated land investing, and if I put in this trust that's then a 100-year trust, my grandkids can get it, et cetera, I'm gonna, really put one over on the IRS and I never have to pay taxes. And then all of a sudden they realize, well, I actually don't have access to my money anymore. So there's 30,000 acres in Iowa that I technically own, but I'm driving a Toyota because I can't actually get to any of that money. So I have seen that happen occasionally, where I'd say if it's stuff that's irrevocable in these tax structures, just take a couple beats and decide, is, in some ways, especially if you're building a technology company, you probably have an engineering mindset, you're an optimizer, you can do the spreadsheets, but is really optimizing to drive your tax bill down to zero? Is that really the most important thing to you versus what you're giving up in flexibility? And, speaking personally, I feel like somebody has to pay the taxes. So if the government gets a little bit of it, that doesn't kill me in order to maintain that flexibility. And then the other, I think, challenge if you get too creative on taxes is, I think it can be tempting to say, okay, well, some accountant is pitching this tax deal to me, so it's probably fine if he's pitching it. Again, for the US, it's the IRS here. That is not a defense of the IRS of some lawyer told me it was okay and some accountant told me it was okay. If you did something that violated tax law, which I have seen a surprising number of creative structures pitched to very smart people that they just assume are kosher because it got pitched to them, and then they end up in, you're probably not going to go to jail if you listen to somebody over it, but you're going to owe a massive amount in penalties and fees if you do something just because you sort of blindly followed the advice. So that'd probably be my only thing, is not to get too passionate about tax savings.
Well, one of the questions that I wanted to ask that comes to mind is, wealth advisors, right? And I mean, I don't want to say that a wealth advisor is a salesperson, but there's all sorts of different flavors out there. Yeah. And so can you name some red flags that someone, might be, what questions should they ask to make sure that a wealth advisor is a fiduciary rather than a salesperson?
Yeah. A couple thoughts. So red flags, to me, far and away, the number one red flag is if somebody pitches some version of permanent life insurance to you. That is a very high commission product that, especially for somebody who's very high net worth, if you have $20 million, you're not really worried about, if I get hit by a car, will my family be okay? Your family will be fine. They'll be very sad, but financially your family will be fine. So somebody who is pitching whole life insurance, variable annuity, something like that, almost certainly is looking out for their bottom line rather than yours. I will give a mandatory caveat, at least again in the US context, something called private placement life insurance. that can have very specific use cases that are actually attractive, but that's not typically where you're going to see pitched. Again, whole life, VUL, indexed, universal, stay away from those and stay away from whoever tried to sell that to you. Beyond that, I would say, I think the idea of wealth managers can get very polarizing. You have this set of people, so-called bogleheads of saying, hey, any management fee paid is just lost money. And even if you're only going to charge me 5 basis points, that's still fleecing me and I should just, do it all myself. Or you have the other side saying, hey, you don't understand how much trouble they can keep you out of. The next time there's a COVID crash, you're going to sell it 30% down. And so you've saved 1% in fees. Now you've lost 30% in crystallized loss. I have become probably much more agnostic or in the middle on that debate. I think I started on the religiously against wealth manager side of things and saying, hey, the only thing you can control is fees, so don't pay anybody a fee. I still personally manage my own money and don't have a wealth manager, but I think that's probably, because I really force myself to learn about it, because I find it very interesting, et cetera. But I think there's a lot of valid uses for a wealth manager, one of which is just, hey, if you are that person who's going to panic sell, I think I've been through enough market cycles to realize that's not me. But if you are that person, I've seen that person, then it's very valuable. Another would be if you just don't find this stuff interesting or you find it stressful and don't want to deal with it. I tell my wife, if something happens to me, you should hire a wealth manager. You should not be doing this yourself. It's not that she's incapable. She's a executive vice president of a bank. She understands money and finances, but it's just not how she wants to be spending her time. And so in that case, paying somebody 0.75% to take all that time and work off your plate and not be tracking your different tax forms and thinking about, what thing to sell at what time to manage cash flow. That's a good use of time. And, or my mother-in-law, she uses a wealth manager and it's largely, I'd say I could do it for her, but she is more comfortable and less stressed having a third party with a bunch of letters after their name as the one doing it rather than her son-in-law, worrying about those dynamics. So in that case, I just think, hey, we are paying tens of thousands of dollars a year just to make everybody happier and keep the family dynamics happier. And if you think about it, that's a very good use of tens of thousands of dollars, even if it's not, required to deliver the service. That intangible value is real. So I would say if I look at our community, maybe if you're looking for more fact-based response, about 2/3 of people self-manage their money and about 1/3 work with a wealth manager. So I think if you talk with a wealth manager, they will tell you there's nobody with $30 million who can responsibly manage their own money. You have to hire somebody. I can tell you that's not true. Most of them self-manage, but I think there's nothing wrong with, choosing to spend a little bit of money for the time savings, the peace of mind, the coaching, et cetera.
Yeah, I think it probably depends on the entrepreneur themselves and what they did. And, you're talking about, a subset of the population who are used to looking at that type of money. It's not like it is a lottery winner that has no idea, right?
Yeah.
You often talk about owners having an in strategy, but not an out strategy. Can you expand on that?
Sorry. Can you
you have a strategy to go into a business and things like that, but your out strategy, the exit.
Yeah.
We kind of already touched on that, but what should and when should somebody start thinking about a strategy?
Yeah. So I will say my answer to that, and this sounds a little bit too cute or a little bit facetious, but I actually think it's true, is whenever somebody is willing to pay you more than it is worth. And so that might be after a year and you've built $1 million company, or you've built something, that you think has $1 million of value, but somebody will pay you too. You should sell it today. It may be 10 years in. Now this thing is really worth 10 million and somebody will pay you 15. But if they pay you 8, even though the 8's a lot more than the 2 before, it's no longer a premium for it. Again, this is on the premise that you have built a profitable or cash flow positive company. So you have that luxury of sales. You've built a stable enough business that's maybe recurring revenue, loyal customers, et cetera. So you're not, too worried about the volatility or maybe has a lot of cash in the bank. Certainly there can be one of those esoteric risks that you're saying, hey, I'm just feeling too exposed to this thing and therefore I have to sell even if I can't get a premium. I mean, I can give you the example of our case and how we decided to sell, which is probably a little bit of both of these. So we had gotten to the point, as I said, we were about 75 employees. We were basically cash flow, we were reinvesting all of our cash flow every year into continued growth. So we're growing about 50% a year, roughly cash flow neutral. The reason that we chose to sell was a couple. One is we had an unsolicited inbound offer. And so we said, okay, this is from a real company, a company we respect, and we would be open to selling to them at the right price. I actually, at that point, went and talked with an investment banker, and I will say that it was a fantastic decision. I'm not somebody who normally enjoys paying any brokers or intermediaries any fees. Again, I don't pay a wealth manager. I'm always resentful with when my real estate broker, makes their fees. But we probably paid him 3%, and that was probably the best 3% that we ever paid anybody. Just because, you go through this experience once, they go through this experience once a month. And so their pattern recognition and their expertise and their negotiating skills, in my opinion, are invaluable there. I'll give a shout out. We worked with a company called Software Equity Group. I'd recommend them to anybody. But so we hired a banker. What they told us, it was actually interesting. At that point, they said, hey, you're not ready to sell. We're not ready to take you on as a client. But they actually helped coach us through pro bono. Hey, over the next year, you have to do this set of things to make if you're serious about selling, this set of things to make your company ready to sell. A lot of it was around cleaning up our books and records. We weren't cooking the books by any means, but we just didn't have a good data set around, hey, here's how each customer has grown month by month and what their revenue looks like. Some of it was around proving out that we could expand our market a little bit more, where we had 95% of our revenue or 99% coming just from US-based customers and just from a couple of products. And they said, hey, if you can get to 15% international revenue and 10% from these other product lines, you've now proven that your addressable market is 3 times as big as before, because you've shown you can sell in Canada, in Ireland, in Australia, in Singapore. And so you can kind of, get credit for that in the sale. So anyway, spend probably a year getting it in a better position. And then at that point, they said, okay, based on our experience, you will have plenty of good buyers who are willing to buy the company if you go to market here. And what we decided up front is we said, okay, there's a certain number at which we're happy to sell. And it was important to me to be very transparent with the bank. If I didn't want you to be upset, if we go through this process, if we don't hit this number, I'm not selling, because I think I am happier owning this company at this price. So don't be mad at me if we don't sell, if we don't hit that number. It turned out we well exceeded that number, so it never became an issue. But that was the half of it of saying, okay, somebody has to be willing to pay more than I think it's worth personally. The other probably sort of push factor for us is there were probably a couple of those. One was we were growing 50% every year. And so I knew a big part of our value proposition was this growth rate. And so if we suddenly had a year where that decelerated to 15 or 20% growth, even though the company's bigger and more profitable now, it's actually worth a lot less than it was before. If your value is kind of size times growth rate, we would have destroyed value by working for another couple of years if it slowed down. And it was just becoming more and more risk that we weren't going to be able, you can only maintain 50% growth for so long. At some point you run out of market. And so we wanted to sell while we were still in that really steep part of the growth curve. And then the other one that was very specific to us is, one downside to having universities and hospitals as customers is they're extraordinarily slow to pay. They always end up paying, they always end up renewing, but we had millions and millions of accounts receivable out there that the contract said we were owed, the customer agreed we were owed, but literally they're like, well, I don't know where the money is. It's in SAP somewhere. You're talking with, if we're a company that's doing millions of revenue, we're selling to a customer that does billions of revenue, they just don't care that much about this. And they really can't be bothered to get the payment out of their payment system into our bank account. And so we just had this risk of, hey, there's going to be some month where the checks are too much delayed and we can't cover payroll. And I don't have enough money in it's one thing trying to float payroll for 5 people, but trying to float payroll for 75 people for 2 months, I literally just didn't have enough money. And so we felt like, hey, there is this risk that there's going to be 1 month when we drop below zero. And even if we're technically solvent, we are illiquid, and that's just as bad as being insolvent in that case. And so we said, okay, we would like to sell to address that risk. And here's a price at which we're happy to sell. And we just told the bankers that. And it turned out, as I said, that, thanks to the hard work we put in, following their advice, et cetera, there was a lot of demand. So it ended up being a win-win, but that was kind of our journey of deciding to sell.
Well, I think your point of trying to speak to peers rather than just professionals really hits home with a lot of people. Let's transition a little bit. I mean, you mentioned the group that you formed, 7,000 members now. What are the types of conversations that might happen at an event?
Yeah. So it's actually a digital first community. I say it's free. We don't charge any membership fees. So if anybody listening thinks it speaks to them, love to hear from them. But so we have an online app that there's probably, 5 or 10 posts a day. They fall into a few categories. Some of it is around personal finance, of people saying, hey, I'm looking for a CPA who can, deal with this kind of QSBS or other tax issue. I'm, thinking about, I've got this warehouse I own, my tenant's coming up for renewal. Should I just sell it? Or is it, I'm not really a real estate guy. Should I keep it? Should I 1031 it, et cetera? So a set of personal finance questions, a set of personal questions. I would say the number one thing our members are worried about is raising their children correctly. It's almost all first generation wealth creators. Yeah. And so maybe in their 30s, 40s, 50s, something like that. So most of them still have kids at home. And they're saying, I think you get into like a few interlocking kind of problems or existential angst here. One is people look at their own success, and most entrepreneurs will tell you that their grit and their hard work and their determination is what made them successful. And so saying, well, how do I make sure that my kids have that? Because I could buy their way out of every problem if I really wanted to. And so, but at the same time, I don't want to pretend that we don't have any money and sort of, lie to them about that situation. So how do I balance and again, have them develop that grit, have them develop self-confidence, et cetera, but also give them advantages that I was hoping to be able to give them by working so hard and generating wealth. So just a ton of questions around this family and how to raise kids and that sort of thing. And then there's a whole set of just personal lifestyle kind of questions of, hey, I now have enough money to take the kind of trip to Tokyo I never could have taken before. What hotel is great to stay with? What travel agent is great to work with? Or, same thing around health and wellness. I'm willing to spend a lot of money on executive medicine now. What is the best version of concierge health out there? What's the best personal trainer out there? So yeah, really finance, lifestyle, and family are really probably the big three pillars. And roughly maybe a third of the topics are in each of those categories.
So yeah, I think raising kids, that really hits home with a lot of people because, my parents were immigrants and they came to this country and they worked really hard. And, I had a fairly good childhood because of it, right? Compared to them. What are some things that you've seen, just to segue just a little bit off topic, that people can do to keep their kids grounded and not becoming spoiled brats and other things like that?
Yeah. And I'll say a lot of this is personal opinion. Not everyone will agree with me on this, but my personal opinion is to not hide the situation from them. Partly, I just think honesty is one of the most important traits out there. So if you're not, eventually they will find out. And if you haven't been role modeling honesty, I don't think that's a good legacy to leave. I think partly it's just impractical. The kind of neighborhood you live in, the kind of vacations you take, the kind of schools you send them to, kind of cars you drive, and just the fact that Google exists out there. They'll at some point your kid's going to Google you, and if they see, oh, Garrett Wong sold his company for $100 million, say, what's going on, Dad? You never told me about this. So I think it's not really practical to hide it. And then I also think, kids really listen to you. They watch what you do and they listen to what you say. And so, especially when they're little, you have this chance to have the open and honest conversation with them about, hey, here's how we made all this money. Here's why I made this money. Here's what I had to do to make this money. Here's how I think about what it can do for us and how to manage it. You either have 20 years while your kids are at home to be doing that coaching and mentoring with them, or you can kind of hide the fact that's happening. And now all of a sudden in their 20s, they discover this and they, felt like you've been hiding it from them and you don't have the chance to have the conversation. So in my mind, just talking openly with your kids is a big part of it. And then the other thing I would say is there's a lot you can do to really take analogies of what you as an adult deal with and put it at a level of, a 5 or a 10 or a 15-year-old. So for example, I give my kids an allowance. It's, trivial. It's, I think $5 a week, but I actually set up bank accounts. I direct deposit their allowance into their bank account so they can look at the statement each month. And then the same way that an employer might match your savings or the government might give you a tax break for donations, I tell them, okay, you can spend this money however you want. It's your money. But if you choose to invest it, I'm going to match it dollar for dollar. So your $5 turn into $10 if you invest it. Or if you give it away, I'll match it dollar for dollar, as you have twice the impact there. And I've actually set up brokerage accounts for each of them. So they will go and they'll transfer their, they saved $20 this month. They'll put it in the brokerage account. I'll match it with another 20. Now they have $40. We'll research a stock together. And then we'll say, they'll be the ones clicking on, I want to buy, one share of CVS. And then they see their dividends for 30 cents the next month. And, it really is actually surprisingly close to the process you go through as an adult, just with much smaller numbers. But I think it kind of feels empowering to them. It removes some of this mystique of, and that there's it's important to me that they're actually the one typing in the app to make every transfer and do every purchase. So they don't feel that that's some scary thing, that they actually understand how to do this when they become adults and get a paycheck for then $1,000 or $10,000. It's really the same thing. And they have that level of comfort with it. And they also see that long-term impact of these small decisions where my son, he's 14 now. And again, on this $5 a week allowance, he now has like $20,000 in his brokerage account because he's been just saving that and getting his match and, picking good stocks. And you see Google keeps going up, et cetera. And so even without spending hardly any money, he's now seeing, oh, well, this can turn into a ton of money. And so I strongly suspect when he gets his first job, he's then going to save a lot of his paycheck because he doesn't just have to believe the math. He'll have that pattern recognition of, what it can do for him. So I think a lot of it is just, open conversations and practice in doing those things. It can feel silly to set up a bank account, a brokerage account, but it's actually a great use of your time, in my opinion.
7,000 members, exits, and different things like that. One thing that always comes to my mind and what I've seen with people, I mean, you hear about the 9-figure entrepreneur that takes an exit and turns into an alcoholic or gets hooked on drugs because everything that drove them to that point was all about the excitement, the grind. Yeah. It wasn't about the money. Yeah. What do you see just anecdotally from your community of people who have what's next?
Yeah. So I do see what you said. I don't think that is most people, but I think there is a set of people. And I think a lot of it comes down to that meaning of either they were working 16 hours a day because they were hiding from some other problem. They could just throw it all in there. Or maybe they weren't hiding from it, but they still were working 16 hours a day. And so
addicted to work, you go to another addiction. Yeah.
Especially if they get kicked out of the company, either, the VC firm doesn't like how they're running it or whatever it is, then all of a sudden you just have these gaping holes in your time and no idea how to spend it. It's not most, but I have seen it. I would say mostly there's a set of people who actually, they're just not that type A. They're like, hey, I built this company, it's super successful. I work super hard, but that is not my passion. I am very happy to spend my time going windsurfing, playing with my kid at the park. I don't need this validation. I don't need to be a big shot to be happy. Like, I'm very happy with the material things that my money can buy me, but I don't need to impress people at a cocktail party with running a company. And so they are very happy, even at, in their 30s, to just retire and hang out. It's not most, but that's maybe 20%. I'd say the most common one is people then start their next company. They say, okay, maybe I'm 35. I either don't feel ready to hang out my spurs, or my kids are at home and they're 5 years old. So they're not just going to see dad sitting around. I can't really spend my full time traveling anyway because my kids are at home. So I'm going to start my next thing. And I think there's a lot of benefits to that, where, say, you were asking about the experience. So now I've got way more experience. I've got deeper pockets, so I can self-fund this thing for a while without worrying about paying the mortgage, and all that benefit. So I think a lot of people will go into phase 2. The very common thing is, if you sell, especially to a public company, you go through this very unpleasant transition where you're still an employee of the company you used to run, and now you're working in a public company. I did this myself, and even I think the world of the company that bought us, but it still had all of just the classic problems of, now I'm spending all of my times in meetings. Now when you're building the company, the only thing you're focusing on was building the product and selling the product. And now you have all this sort of cross-functional garbage of, hey, what does the European field organization think? And what is literally quality, compliance, audit, regulatory? These are all separate functions. They all appear to exist solely to tell you no and to tell you can't do things. And so I think there's a lot of frustration that goes through that. I would say a vanishingly small number of people are actually long-term happy at the acquirer. I thought I would build my career at the company that bought us and kind of work my way up the chain there. And I really tried for a few years. And I was like, you know what? I'm just not good at this. I would much rather go do my own thing again than try and sort of fight the corporate grind. But a lot of people, try it for a few years because they want to make sure the company they sold lands in a good place and their team is taken care of and their customers are taken care of. But everybody gets frustrated.
Yeah. I mean, what you're describing, of course, is, going away from the entrepreneurial lifestyle to now having a boss, having to ask for time off to take your kids to a dentist appointment, all that kind of stuff. It's a bit of a grind. But what about the people who choose to take a partial payout? Mm-hmm. And, like if you're selling out to PE, sort of that another bite of the apple, you might sell at 75%. You've kept that 25, and now you're incentivized to work in there to sell out to the next level of PE. Do you see a lot of that as well?
I do. And I would say I was very skeptical of that when we were selling our company. We spoke with both strategics who said, hey, we're going to buy 100% of your company. We're going to buy it for cash. Maybe we want you to work here, but we're just going to pay you, and you're not required to. And then a bunch of private equity ones where they said, yeah, we'll buy 50 or 75%, and you're going to have much more lockup here. I really did not want to go the private equity route at that time. I felt like you don't want to be half pregnant. I either want to own this company and run this company, or I want to have my money and not care about the results, but I didn't want to be in between. Having seen many other people do it, I actually think private equity route is much more attractive than I thought at the time. I will say that the large majority of the ones I see, actually the private equity company, they may not love them, but the whole point of private equity is to make companies more valuable, and they're very good at it. And so almost always that 25% you rolled over probably becomes worth more than the 75% you sold at the beginning. And also, I think if you want to keep running the company the same way as you did when you're building it yourself, you're much better off with private equity, because a public company can basically afford to just destroy all these companies they buy. Almost none of them are good at M&A. They'll spend, $20 million to buy this company. It doesn't really work, but by that time, 5 years later, nobody's really paying attention. The guy who sponsored it has retired, and it doesn't really matter. Private equity will not exist with that model. They have to make them successful. And so I think they listen much more to you saying, hey, you can't cut my sales team because sales will drop, or you can't cut my R&D team because we're going to lose customers. At a public company, they're just going to cut it. At private equity, it's really back and forth. And this is not universal. I'm sure there's bad ones out there, but having seen a lot of people who sold to private equity, large majority are happy with that, happier than the ones who sold like I did to public.
Interesting. Yeah, I've worked with a bunch of people and met a bunch of people who have stayed along and sold their company 3 times through that. Yeah. And they've described obviously varying degrees of it. Before we wrap up, I wanted to ask, is there anything that you would, your top 3 maybe list of advice for somebody who is approaching a possible exit?
That's a fantastic question. I would say one is the same way I said, hey, build a company that you're happy to continue to own. I think you have to stay true to that through the whole exit process. I think it can be easy to get wedded to this idea of, we have to sell, I have to take this deal, and make too many compromises along the way. And I think you can end up giving away millions of dollars of value. Of a buyer can sniff that out, especially if you're talking about a private equity buyer who's, very good at this sort of stuff and does it every day. So I think keeping disciplined of not getting too attached to the deal, and being both emotionally willing to walk away and continue to run the company very well so that you financially can afford to walk away and come back 2 years later to do a deal. I think that would be a key thing. Second, as I mentioned, I don't think you should feel really any pressure to think about what's going to happen after until you get to after. It is already incredibly challenging to spend full-time running the company and full-time selling the company. And in a lot of cases, not actually telling your employees or customers that you are looking at selling the company. And so I think it's too much to try and load on top of that, also thinking about the day after. And then, I'm not sure if I have a third piece of advice, but my third piece of advice is look very hard at working with an investment banker. As I said, it was not my natural inclination to pay somebody, but I would say so the number I said is our bare minimum number. We got almost twice that number by working with an investment bank. And I know I would not have been able to either find the company that we sold to. I would have had a much smaller universe of buyers, and I would not have negotiated as hard. I remember at one point I was like, hey, I'm really happy with this number. Let's just take it. My banker said, no, I know there's more money there. I'm going to push for it more. There's no way I would have done that. I would have just been too nervous about blowing up the deal. If I hadn't had somebody working with me.
Well, that's why we need experts, right? What are those? I love that quote. A lawyer who represents themselves as a fool for a client.
Exactly.
Right?
Exactly.
All right. Final question. I ask every guest this on the podcast. Really interesting to see what you have to say since you've had an exit. This is the Investing to Win podcast. How do you define success, and what does winning look like for you?
That's a fantastic question. I articulate my answer. I'll have a little cop out of I see 2 very valid frameworks for people who've been through an exit where they have enough money. They have significantly more money than they need. I see one set of people say, hey, I have enough money that I can afford not to take any risk. I can put my money in T-bills and earn 4% a year and have everything I want. So there's no reason to take that risk. And then I see the other set of people say, hey, I have enough money. I could afford to lose half of this and it's not going to affect me at all. And so I'm going to go in a very risk on position. I'm going to maximize what I have in 30 or 40 years or what I leave to my kids or what I leave to charity, and being willing to accept a lot of volatility along the way. It's funny because they're both logically sound, internally consistent approaches that lead you to wildly different investing strategies. Myself personally, what's interesting is if I look at myself and my wife, we have different answers to that question. I say, well, I'm fine with volatility. I've seen it before. I'll see it again. That's what made me an entrepreneur. I care about what is my IRR in the long term. I'd say she is much the opposite. She cares about what is my downside. We have enough money. I want to lock that in. So what I've tried to come to is basically something in the middle of that, of say there's certain things that are economically, not optimal, like paying down the mortgage, that I'm willing to do just because what I'm buying there is peace of mind. But then for the money I do have that is beyond that, I'm not going to put any money in bonds. I'm going to put my money in stocks, into private equity, private credit, oil and gas, music royalties, et cetera, all these things that have high expected returns, but higher volatility. So basically not do a lot of leverage, cap the downside in that way. And then the other thing I like is have enough income, cash flow generating things that if we're in a position where we can say, okay, basically between rental income, interest, et cetera, we can cover our passive cash flow. Then beyond that, I'm going to swing for the fences on the rest because I've already, made her comfortable that we've got the passive income, and then try and maximize the upside.
Love it. Yeah, no, we have to take care of those and be respectful of how they feel, even though like perception is 100% a reality, right? I love that answer. Well, we'll wrap up here. Thanks again for coming on the podcast, hanging out with me for the last hour. It's been really, really insightful. We'll talk after in the green room. I have a pretty good network of high net worth people that I can maybe even introduce to your group. But thanks again for coming on today.
Yeah, thank you, Garrett. Yeah, as I said, if anybody's interested, just check out longangle.com. You'll see more about it there and be happy to speak with them.
All right. Thank you.
All right. Thanks.